Hi, I'm Steve Van Metre, and welcome to our Wednesday Night Live, where we take about 15 minutes to discuss, well, mostly things that are on my mind that have to do with the economy and the stock market. So the big question I've been getting, phone calls, emails, is should I buy PG&E stock, and why not? It's trading 90% below its 2017 peak. Of course, a lot of people were thinking, well, gee, PG&E is not going out of business. They've got customers all over California, and certainly this is bottom fishing 101. But let's take a look at some of the facts, because maybe, just maybe, this isn't the buying opportunity that everyone thinks it is. Now, first of all, I checked California code. I'm just going to presume that everybody watching this is well aware about Campfire and how some of the liabilities at the moment that PG&E is up for. About $30 billion at the moment. I assume that number is going to go substantially higher. Now, according to California law, PG&E is liable whether they are deemed negligent or not. And, well, a lot of experts say, well, they were negligent, and so they will be found guilty. Now, the reason people are so excited about the stock being down 90% is because in the past, the state of California has bailed PG&E out of problems. But this one just might be too big for the state of California. And so far, the new governor has said, well, this puts a crimp into some of my plans that I had to do. And so far, he's not indicated that he's going to bail out PG&E. Some of the other issues that have come up, the CEO has quit. They skipped the interest payment on an $800 million bond recently. They tapped all of their equity line of credits at every bank that they could access money to in late December. And the damages so far are about $30 billion. And again, that number is only going to go higher and higher and higher. Another issue that is coming up, well, they are a member of the S&P 500. And from what I understand, they are going to be delisted and removed from the S&P 500. And what does that mean? Well, there are a lot of index funds, exchange-traded funds, mutual funds that track the S&P 500. And guess what they're going to have to do with the PG&E stock when they're removed? They're going to have to sell it. Now, some people say, well, that's really bullish. Maybe not so much. Because if PG&E goes into bankruptcy, which they're expected to file Chapter 11 later this month, there could be other money managers that are required by their investment policy statement to sell. So they might be forced out as well. So do I think this is a bottom fishing opportunity? And I don't, and I'll tell you why I think it's not. And it's not because I think PG&E itself is going away, because obviously there are millions of people that receive utility services from them. That part I don't think is going to change. I think this is a General Motors type issue where General Motors went bankrupt, and then they mysteriously got recapitalized and came back. But what happened to the original shareholders of General Motors? Got wiped out. And I think we could see that again. So anyone chasing PG&E stock right now, well, you're truly bottom fishing and truly hoping for a miracle, because the thing that people maybe don't understand about insurance is when your house burns down or business or something burns down, assuming you're insured, which I presume that most people are, your insurance company is going to come in and they're going to rebuild the structure. And then they're going to go sue who caused it to burn down. And at the moment, that's PG&E. And also at the moment, those lawsuits haven't started yet. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre in my own personal capacity. The views expressed in this video that do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial. Advisory services offered by Atlas Financial Advisors, Inc., a registered investment advisory firm. So, Kimberly, thanks for joining us. Who else do we have on here? Someone just disappeared. Where did they go? I can't see for some reason at the moment, but that's okay. So I want to take the bulk of our time and look at some charts and see what's just kind of going on. I do want to spend some, probably most of the time looking at the gold miners, see if I can figure out who else is on here, and without goofing this up. And oh, Dinah, thanks for joining us tonight. I'm glad you could be here with us. So let's take a look at the S&P 500. This is looking at the weekly moving average. Now, we haven't looked at this in a while. But it's certainly worth looking at, because if the S&P bounced off its 200-week moving average, and lo and behold, now remember, everybody is really bullish right now. Everyone thinks that this is a mild correction. Stock markets are going to all-time highs. They are not, and the main reason the market isn't is because the Fed is still tightening. You never get bull markets 3 years into the Fed tightening cycle. We are now 3 years in, never in history. So unless people don't think higher interest rates actually matter in the most indebted economy, in the most domestic and world economy, unless they don't think that matters, we're not in a bull market. We are now in a bear market. So let's go back and look at those weekly moving averages. And what do we see? The S&P 500 came right up to its 100-week moving average, which is at 2618. And so far for the week, it's sitting at 2616. So it's telling us this getting rejected right here at resistance. Now I have resistance at 2600. Usually resistances run in a band. There's like a kind of a, think of it like an alleyway between here. So you have a low and a high, and I just put in one of them because you get too many lines and really it's hard for you to follow. But let's take a look at what's going on after hours, and we can see what's kind of unusual lately is in fact, after hours over the last week, it's been going up, and now we're seeing things go down. So I suspect that will continue, because today $20.1 billion of currency was destroyed by the Federal Reserve as part of their plan. And that is not good for liquidity purposes. Looking at the daily charts, we see the S&P decided to come up and just kiss its 50-day moving average. I'm kind of surprised it got that high. But at the moment, this last just jump over the last day or two appears to be what's called a bull trap. And what a bull trap is when people get overexcited, they get into stocks, and then all of a sudden it reverses direction. And as I mentioned before, I think this is going down quite a bit. How far down? My best guess is going to be somewhere between 1,800 and 2,100, somewhere down in here where it flushes out all the people that bought, all the retail investors who bought in here. That's what I suspect will happen. But the key is nothing will happen until the Fed stops. The market will need to fall enough until the Fed stops. So let's take a look at the 10-year Treasury yields, and you can see they came up, hit resistance from going back over the last year here. And you see they hit resistance here, kind of came down, and the market made another run at it and got promptly rejected today. And in after hours trading, or Asia markets trading, yields are dropping. Looking at the long bond, this is kind of interesting. You see just this absolute rejection here by the bulls, and they just drove interest rates up to 3.1 right at the prior level of resistance. That's pretty cool. And today that got rejected, and I didn't look at the 30-year bond, but if 10-year Treasury yields are down, so are 30. All right, so let's take a look. You know what? I should look at PG&E stock just for fun. So here's what people are excited about. Let's go back 2 years, because you can see here's the peak at 71.57, and here it is today. So that's minus 90% return for the shareholders. I'm sure many of them, as they get their statements, will not be happy. But what's interesting, you're seeing a lot of volume here. You can see here, normal trading volume for PG&E was around 3 to 4 million shares a day. They got some buy ratings right in here from investment banks, and that should be a code word never to listen to what they tell you on TV. And lo and behold, now there's 127 million shares traded, then 173 million shares, and then today we saw 78 million shares traded. And that, if we go back as far back as we can go, you can see it doesn't ever trade those many shares. So that is not a good omen. There's some bottom fishing here, but there's some big players that are being forced to get out, and I suspect this is going to go down even further. My best guess is PG&E is probably going to zero, and they'll reissue the stock somewhere else. All right, so on to the gold miners. Let's see what we've got going on here. Where are they? Where are they? There it is, gold mining. And we're on, let's zoom out to the 2 year. So we saw this nice pattern before where I thought this was the bottom. You're thinking, okay, this is it. This thing's going to take off, and it didn't. It dumped down into here. It saw a little head or left shoulder head, right shoulder, small reversal, popped up here, got rejected. Notice these downward trending colored lines, the green, blue, and tan. These are moving averages, 50, 100, and 200 day respectively. And when you have a downward trending moving average, price just struggles to get over it. And finally, it got over that here a couple weeks back, or well, looks like back in December, and it came up to this heavy level of resistance. I'm going to try to zoom out a little bit further for you to see if we can see that. So this here is a heavy level of resistance. I mean, this might as well be a gigantic wall. No, that is not meant to be a comment about the border wall, but it's just a massive giant wall here, overhead resistance. And I did not expect to see this break through. Now, what I expect to see is come down and either to confirm this dotted purple line or one of these two moving averages, the 50-day in green or the 100-day in blue. Now, why is that? Because market rallies start, they have an interesting function is they first have to cross a moving average, and then they have to confirm a moving average. And that almost happens every time. The only place you're not going to probably see that very often is a bond market because the banks can buy a lot of bonds. So let's go back and look. So we'll zoom in here, if I can get back to that. And let's take a look at this, the close-up picture. So it came up here to resistance, and you can see buyers were trying to get over it. And look at the volume tapering off. So it's saying the buying interest is waning. So all these people that are buying are just running out of effort and money, and it's rolling over. So we want to see it come down here and confirm probably the 100-day, because you can see it's really found most of its resistance there. So where else do we see this trend? Well, we can go back and zoom out, and then so we can slide this across a little bit. Here's another example of a bottom. Now, most people never attempt to trade these because it's very dangerous. But you'll notice it crossed over the moving average, reconfirmed, and took off, but it just got rejected over here. Came down, reconfirmed it, which would at the onset be bullish, but it just couldn't do it, and it went down there. But the setup here was what we're looking at back there. It was just more in a kind of horizontal trend. But let's go down to a bottom. So here's a bottom where it was dancing between the 50 and 100-day, kind of bouncing around, and it crossed over here, and then it briefly reconfirms it, crosses the 200-day, briefly confirms it, and it's not until much later do you get a confirmation of the trend way up here. And why is that? See all this cayenne, these bars? That's trading volume. When you get spike after spike after spike after spike after spike, a lot of big players buying in. So let's look at over here. So what happened is this thing crossed the 50 and 100-day and then nudged over the 200-day. So let's see where we're at right now. Well, there's your 100-day, there's the 50-day, and it's trying to get over the 200-day. So the setup is good where we have the shorter-term moving averages pulling upward into the longer-term moving average. That's what we want to see. Now, I didn't look at the weekly moving averages because, sometimes it's fun to do things live and see. And if we zoom in, we can see right here the 200-week moving average is acting almost as an area of resistance. So once it kind of cracks through these weekly moving averages, let's see what happens. And you can see when it gets over these weekly moving averages, it really runs. And as of now, all of the three major weekly moving averages are right on top of each other. So you can see this rally here got stalled out at the 200-week moving average, came down, and then took off. This next time this breaks out, there's nothing holding it back. And that's what really makes the gold market pretty interesting, because usually when stocks really go down, you get a lift out of the bond market just as a design of the monetary system. But when you realize there are several hundred trillion or more unfunded liabilities and bills that need to be paid, well, there's two solutions. You devalue your currency directly, or you print a lot of it to pay people. When you do that, well, you tend to get gold prices going way up. Plus, deflation is also good for gold because people want to take something that is becoming worthless, and this paper towel could be as worthless as a piece of paper, could be a dollar bill. Well, as this becomes worthless or worth less, what do people want? They want to trade it for something of value. And, well, gold is a store of value. So let me just quickly check and see if I have any questions. I don't. I appreciate Kim and Diane, you joining me tonight, and I will look forward to hopefully seeing both of you on Friday for a more comprehensive, in-depth weekly economic update. And keep in mind, next Tuesday, we're going to do an encore presentation of the tax class, and hopefully we'll look forward to seeing you then too. I'm Steve Van Metre. Good night.